finish up options and a little bit of class review just to make sure you haven't forgotten everything we talked about in this class. There should be some residual. And then any questions on the exam and what we're going to do with the exam. And the advertised Pepsi on my YouTube. All right. So we've talked about protected put, covered call, and collared. So today we're going to do strangle or straddle. And again, I'm not real picky if you know the difference between strangle and straddle. It's, to me, they're all strangles, because straddle is something you do right at the money, which I'm going to show you with Facebook. I try to do a straddle as close to the money as I could. And then a strangle is the same thing out of the money. The shape's a little different. One looks like a V, the other one looks like a V with a base, but pretty straightforward. A strangle or a straddle is when you just buy a put, you buy a call. You do it at the money, it's a straddle. If you do it out of the money, it's a strangle, but either way, it looks very, very similar. So I'll do it with Facebook. Let me find our file. So we're not going to do a spread, we're going to do a straddle. So let's do Facebook. Facebook's current price. Have y'all noticed the 10-year treasury? What's the 10-year treasury doing? That's interesting. Getting close to 3. Boy, it did hit 3 today. Y'all are thinking, wow, the interest rates are getting really high. But I'm thinking we're thinking about a 3% 10-year treasury being a high number. It never hit 3 my entire career, ever. I went through a 30-year career and never saw a 3% 10-year treasury. And now we're thinking, wow, that's so high. It spent over 50% of its life above 4.5%. So are we into this new world with higher interest rates or not? If you want a really good discussion on this, I do highly recommend the Hoisington. He just put out his first quarter. He's my favorite. Lacey Hunt's my favorite economist. So maybe Juan Carlos, you want to, oh, you're not economist, you're market outlook. So maybe Alex could do this. He has really, really good information, but he's called interest rates really, really well the last 10, 15, 20 years. He's an investor up in Austin. He's an economist, but he's the economist for Hoisington Asset Management. And I don't say he's always right, because obviously no one's always right. I just think he has a perspective that's so unique. He brings in data no one else talks about. He talks a lot about the money supply, the velocity of money, which he says is really important, the multiplier effect, which he says is actually negative now, and he has data that actually shows that. He talks about the deficit. One thing I think is interesting about the deficit is how dishonest our government is on the deficit. He says, they say we have a deficit of 500 billion, but that's not the deficit. The deficit's much higher than that. Why? Because our government keeps classifying things as investments. They're investments, so it's not spending, so there's no deficit. Like student loans that the government's never going to write off, right? So, and he compares it and says, boy, we're in far worse shape, government debt-wise, than our government tells us. And he has some incredible numbers he shows that are really, really quite fascinating. So I recommend you read it. It's not a real long read. His paragraphs, I'd count off for him on his paragraph length, but really good writer. And he puts his quarterly out there. This has been out there a couple of weeks, so it comes, probably his next one will be July 19th or 20th or so. So I highly recommend. This is a good page to keep up with. But yeah, we got a 10-year approaching 3%, hasn't quite hit 3%. But that is You look at today, the 52-week high is today's high. So we are the highest we've been in a year, pretty obviously. We're actually getting pretty close to a 5-year high, which is pretty amazing. When was this? 2018, we got 316. And then the Fed started cutting rates, and then we got, so you're living in interesting times. All right, so we're going to do Facebook. So the current price is, yeah, what does that? Current price is what, 211.13. So we'll go out and we'll do options. Y'all remember how you do this in Bloomberg? I remember what I gave y'all on that. It's OMON. I don't know what all the letters stand for, but if you go into Bloomberg and go OMON, it gives you the option chain, which is what this is, but it also gives you some scenario analysis. And I don't know how many legs you can do, but you can do multiple legs. You can buy a put, you can sell a call, you can buy a call at one strike, sell one at a different one. You do all kinds of stretch scenarios, and then they let you do analysis off of that. All right, so here we are. Let's go out to a, let's go out to August. Yeah, maturity. And we're going to do strike price. Let's do 210. So we're going to buy a call. We're going to buy a put. That's it for the longest straddle. If you're short a straddle, you sell them. Which is more dangerous, a long straddle or a short straddle? Short would be. Anytime you go naked on options, you have unlimited loss on the calls. You don't have unlimited losses on the put because the stock can only go down to zero, but that's still pretty close. I don't think Apple stock is going to go to zero anytime soon. So they're unlimited. All right, so 210. 2360, 2390, we're buying. So what do we pay? We pay to 2390. And then the put. We'll pay to 2170. So we're going to buy both of those. That's incredibly expensive. Now, how do we make money in this? If the stock goes up, what's going to happen to our put? Stock price goes up, our put is going to be worth what? Pretty close to zero, right? It's just going to fall to zero. What's the call going to do? It's going to shoot up and back. But when do you start actually making money on the call? The stock goes up to 215. Have you made money on the call? You haven't, have you? How high does the price have to go? As soon as the stock price hits 235, you're made money in the call, but have you made money? What else do you have to do? You also have to offset the put. So when do you start making money? As soon as it hits 256. The stock's got to move dramatically. And I'll actually show you because you're going to be kind of shocked what happened last week. All right. So our strike's 210. The put is slightly in the money. The call is slightly, no, this call is slightly in the money. The put slightly out of the money, but as close to the money as I can get. It's essentially at the money. So let's do expiration. So let's say the stock on the exam, I give you the expiration, but let's say the stock is worth 130. Let's see. Go up to 300. So the stock gain is just like we said, you just take where it's worth today, what you paid for it. So in that case, you lose a lot of money. So just a straight line, diagonal line. The call gain, like we've always been saying, equal max the stock minus the strike, 0. In that case, it's worthless, right? If the option fall, I mean, the stock falls, the call's not going to be worth anything. Minus what we paid for the call. That's not any different, right? Giving you a straddle is nothing new. You're just going to buy a call, buy a puts. So there we lose money. The put gain. So there it's max the strike minus the stocks. We're going to make 80 bucks there, but it's going to cost us $27 to do it. So there's our gain and our loss. Here's the straddle. The straddle, you just add across. So what letter of the alphabet is this going to look like? A hint, when I'm learning Spanish, it sounds a lot like another letter in the alphabet. Taught me, what was it? Baca, B, I forget the other B. What's the one for B? Did y'all used to say that? Baca? Or V for cow? What's the other one? B for burro. Yeah. So this is B vaca. This is going to look like a V if I do the actual chart. Kind of looks like a V, doesn't it? So a straddle looks like a V. A strangle will have a little bit of a cup at the bottom. But a straddle will look like. Now a strangle is going to be a little cheaper because you're out of money. We can try a strangle next. But it looks like a V. If you do a short straddle, you just do everything negative except you got to switch the premiums, right? You have to use the bid instead of the ask, but it's the same analysis. So does straddle look like a good strategy? Well, you know the most you can lose is 45.60, which is where you started. That's the worst you can do. 45.60, that's where you started. If the stock doesn't move at all, you're essentially going to end up where you started. I'm actually surprised it doesn't give us a little bit of a gain at 210. So 45.60, that's the most you can lose. Now, the fact that the put is slightly out of the money means it's going to be worthless. The call is slightly in the money. So, yeah, I guess at a 210 and 210, yeah, it's 0. So, yeah, we're at 210, you'd be exactly out the money. So 45.60, that's the most you can lose, but that's a lot of money. 45.60, that's like a stock price for a normal stock. So you're spending a lot of money on this. All right, so I'll ask you, when do you want to do a straddle? Are you hoping for calmness or are you hoping for radical volatility? What's your goal here? Do you want Facebook to announce something radical and their stock goes crazy, or do you want them to just kind of peter along the straddle? You want radical. If you're shorting a straddle, what do you want? You want no news, everything's just nice and calm. So a straddle is a bet. What letter was it in the alphabet? V, what word starts with V? Volatility. A straddle is a bet on V. V, not for victory, but for volatility. Okay, so straddle is a bet on volatility. You're hoping for volatility. When might a stock have a lot of volatility? What particular day in the quarter might that happen? Earnings announcement. Did Facebook announce some earnings recently? Can you tell when they announced earnings? On Thursday. And how did the stock do? It was up a lot. What if you'd entered a straddle last Thursday when the stock was trading for 175? What would you have done? Your assumption would be what? You killed it, right? Because the stock moved a bunch. What do you think you actually did? Hold these numbers this morning. So, or I guess on Wednesday. On Wednesday, the call option, this is when Facebook was trading for 175. This is a straddle at 175. You can tell it's right at the money because the put and the call are about the same price. You would have paid $14.90 for the call and $15.25 for the put. So you would have spent $30.15. The next day, they report earnings that the market said it wasn't like fantastic numbers, but the market was expecting horrible numbers and they got decent numbers with it. The stock was up, I don't know, 20, I forget how much. I should know, I own Facebook, so you would think I would have noticed that. So 175 to 205, 174.95. And then it jumped up to 205.73. So 18%. It was up over 20 at one point, so up 18%. You would think if you had a straddle on a stock that goes up 18%, you would make a fortune. So what happened? The put fell dramatically, as you would expect. That makes sense, right? You could have bought it at 175 when it was at 175. I mean, you could have sold it at 175 when it was at 175. Now you can sell it for 175 when it's trading for 205. So that dropped a bunch, but the call was up a lot. If you just bought the call, you would have been pretty happy because the call was up 116%. So your best bet last Wednesday is just bought the call. That would have done great. You're probably been better buying it 5% of the money, but still, it would have been 116% versus the 18, but you didn't. You bought the call and you bought the put. So the call jumped to 32, the put dropped dramatically, not 100% obviously, but it dropped 90%. So you're telling all your friends, hey, I just became the multimillionaire. I did this Facebook trade. And then you look at it and how did you actually do? You went from $30 to $33.83. Does that sound like a kill transaction? Not all that spectacular, is it? You're up 12%. You're not even up as much as the stock. So don't assume that a stock moves a lot that you make money on a straddle. Now, why was this option so expensive on Wednesday, do you think? Because on Thursday, it's going to report earnings. So what do option prices get really high right before earnings announcements because there's a lot of uncertainty, a lot of volatility. And so you were paying a lot for this. You tell everybody, wow, I did a straddle on Wednesday on Facebook, and they're thinking, oh, what are you up, like 80%, 90%? No, I'm up 12%. Just doesn't sound all that spectacular. So do straddles make sense? Straddles can make sense if you really watch the volatilities. If the implied vol is really high, a straddle is going to be really expensive, and it may, you know, if you look at something and say, well, this stock needs to be up 20% before I start making money, boy, that's not that's not all that great. So yeah, you got an issue here. Now here on the stock, you got 205. Your actual intrinsic value is only $30.73, and you're getting $32.20. So, you know, the stock just needs to go up much higher. Would you keep this straddle in place? You would have done better today. So today, if you'd held on to it and sold it today at the end of the day, or whenever I did this math, it would have been up 28%. So holding it on for a few days. Once you get into the positive, it starts getting much more valuable to you because you've lost about everything you're going to lose on the put. You can see the put price doesn't really move all that much anymore. Once the put falls, it's just cheap insurance. And then you just have, and maybe even you sell the put, get some money out of it and move on. So don't assume just because the stock moves a bunch that a straddle is really going to help you. Now, if we did this out of the money, that's going to help us somewhat because the options are going to be cheaper. So let's try this same thing. We'll do a strangle. But here, let's do a strike price on the call. Let's do 225 on the put. Let's do 190. So 225 on the call. So that's only $17. So that saves us quite a bit of money, right? That's a pretty hefty drop. And then 190 on the put. It's only $13.50. Again, saves us quite a bit of money. So here, our call gain is going to be off of 225. And our put gain is going to be off of 190. We still can't get, I can't get the barrel for some reason. I'm not sure why, unless maybe the chart's referencing the wrong data. Yeah, let me try this because I should get some base down there. It may not be huge. There we go. Ah, that's actually pretty good. So that's, you see how a strangle looks a little different. It's a lot cheaper. I should have done a Facebook strangle so you could see that might have worked a little better because you would have cut your premiums down. So a strangle is a lot cheaper. The most you can lose here is $30 versus over here, you can lose 46. So you're cutting your max loss by a third, which is pretty material. You don't make as much on the upside, but you at least prevent yourself from, and it's not actually all that bad on the upside. You prevent yourself from losing a lot, but you're going to lose quite a bit in a pretty wide range. So you look at this, I mean, the stock's going to have to get up in the 40s, 240s, 250 before you're actually going to get excited about it. All right, so that's a strangle. Pretty good strategy in some cases. A friend of mine, he was an engineer and he quit engineering and became a finance person. And he's doing these type of strangle trades right around earnings announcements and doing it very, very controlled. He actually looked at the implied volatility and makes his bet based off of that. So looking historically at the volatility around earnings dates, and he's trying to find options that he thinks are mispriced. And he was consistently making 10 basis points a day. That may not sound like a lot, but in 250 days, that's a 25% return with very little downside. He was really controlling his downside. So if you can make 25% on average because you make 10 bips a day and your max downside is really protected, it can work. But that's the kind of trade he was doing. So, all right. So that's our last position. So we're long call and long put. We don't own the underlying, and it really doesn't make sense to own the underlying in here. I don't know what that would look like. Be kind of strange, I would think. Try it. I have no idea what it's going to look like. Kind of a kind of an upward kind of spike at the end, I would think. Yeah, it looks like looks like a call option. So it's essentially a protected put with an extra, a call option, but with a little extra oomph in the end, a little better steepness to it. So those are all the strategies you need to know. You need to know the intrinsic value. So this is the intrinsic value, a call. This is the intrinsic value a put. That's what that formula is, all right? So make sure you know that. Extremely important, you know that formula, X minus S or S minus X. I don't know why I put the put first and the call second. So the only last thing we need to talk about is time value. So time value is option premium minus intrinsic value. All right, so you do have to calculate time value on the exam. I'll show you a few. If you're out of the money, time value equals what? Anybody know that? If you're out of the money, the time value equals the option premium. And why is that? When you're out of the money, intrinsic value is what? 0. All right. So if you're out of the money, time value is the option premium. The option premium is 100% time value. All right. Let's do a few examples. Facebook is at 211.13. Let's do a call with a strike of 215. The option 215 is 2140. Intrinsic value and the time value. Anybody tell me the time value on this option? Now, one thing to be careful of, the intrinsic value of a call is not that entire formula. It's max, of a put. Okay, sorry, boy, I'm glad I saw that. This is a put. I don't know why I put the put first. That's really bad. So the intrinsic value for a put is the max of X minus S, comma 0. It's not minus the premium. The intrinsic value of a call is max S minus X and 0. So that's the intrinsic value. So here, the intrinsic value is going to be equal max the stock minus the strike, comma 0, which is going to be what? It's going to be 0 because it's out of the money. You would never buy a stock for 215 when it's currently trading for 211. So then what's the time value? Option value minus intrinsic value, it's 100% time value. So if you're out of the money, I'm unlikely on the exam to give you an option that's out of the money to do time value. So you see how I put that formula in there, max of stock minus the strike, comma 0, that's 0 because we're out of the money. So anytime your intrinsic value is 0, you're out of the money, or you're right at the money. Okay, let's do 190. Oh, boy. So 190, 35.75. So what's the intrinsic value equal max? The stock minus the strike, comma 0. That's $21.13. So what's the time value? $14.62. Does that make sense? What does time value do over time? We say decays. So this is what we call time decay. It decreases. So time decay means as you get closer to expiration, that time value is going to get closer and closer to 0. So at expiration, the options be worth its intrinsic value. And what I discovered on my career, and I had a lot of help from my option trader, is that time value declines fairly slowly until you're about 30 days out, and then it just starts to nosedive pretty rapidly. So time decay is not so bad about 40 days out. That's why if you're long an option and you want to roll it forward, you probably want to roll it forward about 30 days out so you can get some of that time value back. You have to pay more time value. Like if you sell a 1-month option and roll it over into a 2-month option, you're going to pay more time value on a 2-month, but you'll get to capture more of the time value remaining in the current one. So it actually ends up saving you money. So time value, time decay is your enemy if you're buying an option. It's your friend if you're shorting an option. All right, let's try the same thing with a put. So let's say the strike is 190, 215. So the option 190, the put is 1350. And 215 is 2420. Intrinsic value, you just do equal max. And here we start with the strike and we subtract 0. So in this case, 190 is out of the money. You don't want to sell it for 190 when it's worth 211. That doesn't make sense. And then your time value, you take the option price minus the intrinsic. So its time value is 1350. And then here you do equal max the strike minus the stock price 0. That minus that, there's your time value, $20.33. So you're not have to learn anything new for intrinsic value. It's the same formula. You just don't subtract a premium at the end. It's just S minus X comma 0 or X minus S comma 0. That is the intrinsic value for an option. And you just compare that to the time value. And at expiration, intrinsic value should be exactly 0. There's nothing else. There's no more to do. I mean, it's just you're either going to execute or you're not going to execute. And if you're out of the money, it just expires worthless. Right. So those are all the problems that you need. So let's try this again. Long call, long put, call intrinsic value, put intrinsic value, protected put, covered call, collar, straddle, strangle. All right, long call, the gain or loss is going to equal max stock minus strike comma 0 minus the option premium originally paid. This is the gain or loss at expiration. I'm not doing anything between expiration because that's where we get option pricing models. So see how we keep using this formula over and over again. The gain or loss put equals max X minus S comma 0 minus the option premium when paid. So those two calculations you have to do on the exam, pretty simple ones. I think 90% or more of the students get that with no problem. It's just plugging numbers into a formula, pretty simple to do. What's the call intrinsic value? Max S minus X comma 0. For put, max X minus S comma 0. That is the intrinsic value. How should you put time value? It's the same for call and a put. It's option premium minus intrinsic. Probably about 50% of the students get that one right. And then I lost one. Protective put. Anybody remember that? What do you own? Protective put, you own two things. Two things you own there without looking in your notes. You own the stock, protective put. So you're long the stock. What else do you own? I mean, it's kind of in the title, isn't it? You're long a put. So gain at expiration is going to equal stock 1 minus stock 0 plus max X minus S comma 0 minus put option. So you get the stock gain or loss. Look at the stock today minus the original. Compare that to the intrinsic value of the option, X minus S comma 0. Subtract the option premium, and that gives you your gain at the end. The max you can lose in this case, remember, is how far out of the money you are on the put. So you lose that. So if you're 10% out of the money, the stock falls 10%, you've lost that. Then after that, the put protects you from any stock losses. So at that point, all you lose is that premium. So the most you can lose is where you started minus the strike and then the option premium. After that, all your losses are covered. You can't lose anything more. What about a covered call? Do you own the stock here? Remember? Yes, you do. Own the stock, and then what do? Got the word call in there, so I got to know is if you're long or short on the call. So what do y'all think? So plus a short call, the gain's going to be S1 minus S0, and then minus, because here you're short the call, max S minus X minus call premium. So this is minus, but then this is minus. So you're receiving the call premium, but then you're losing money on the call. If the option expires out of the money, the strike is greater than the stock price, and this is 0, and you just collect the premium. You get the premiums, can protect you from some of the losses on the stock on the downside, right? A collar, just on a collar, just think you combine protected puts and the covered call, and you just combine those two together. So you're long the stock plus long the put plus short call. So your gain at expiration is going to be stock 1 minus stock 0. How much you make on the stock plus the max S minus X. I'm sorry, X minus S for the put minus put premium minus max S minus X comma 0 minus the call premium. And there again, we're minus the minus. So you're receiving the call premium and you lose whatever the intrinsic value of the option is. That one was the most complicated one, but if you did if you do the protected put, you do the covered call, you're just essentially just combine all that together. Just remember, if you're buying something, use the higher option price. If you're selling something, use the lower selling option price. You don't have to know what the bid and ask are. So do I use the bid or use the ask? It's pretty obvious. If you're buying, use the higher price. If you're selling, use the lower price. Always really simple. And in the straddle, we just did. You're just long a put and long call. So gain expiration is pretty straightforward. Max S minus X 0 minus the call premium plus max X minus S 0 minus the put premium. So that one's pretty straightforward. You're just combining a put and a call, and you're buying them, so you're just using the higher price. Nothing unusual there other than just knowing what a straddle or a strangle is. So those are the ones we're covering. There's a lot more than this, obviously. There's a lot that if I heard the name, I would not know what it is, because I can't keep track of the dozens and dozens of these out there. And I think some people are creating new strategies just so they can get their name on something. So trying something really wild. I don't know how crazy you can go. But so this one has two legs. You got a stock and you got the put. This one has two legs, the stock and a call. This one has three legs. This one has two legs. So if you go to the Bloomberg machine, I know they let you do at least 10 legs, and it might be more than that now, but 10 legs, you can go pretty wild with this. How do you get more legs? Well, that's where we don't have on the exam, but as a spread. So a spread is when you're either mixing maturities or mixing strikes. So you might buy a put with a strike of 190 and sell a put with a strike of 170. Or just the opposite. You might buy a call, you might sell a call with a strike at 220 and buy a call with one at 250. Or you might buy a call that matures in a month and sell a call that matures in 2 months. Back in 2008, I couldn't do anything because of my job, but back in 2008, the December call at a greater price than the March call. And boy, I wanted to buy the March calls and sell the December calls, and there was almost no way I could lose money on that transaction. And there really was no way I could lose money at expiration, because we know the December call is going to either expire worthless if it was out of the money, or if it's going to expire at its intrinsic value. We know that March call is going to be more than its intrinsic value. So no matter what happens at expiration, so I was like, let's all get together and put like $2 trillion into this, because it looks like a really good deal. What I don't remember was the bid ask, and the bid ask might have killed me on that trade. That might have been the problem. I was looking at the actual prices themselves. So it may not have worked, but you're not going to see that, right? That doesn't exist. Why did that happen in 2008? Just markets were just in turmoil. Everything was just crazy. All right, so when I do the exam practice, you'll get to see how we set all this up. Any questions on any of this? Did y'all know this when you started the class? That was just redundant? Or is this new stuff? Michael, you've probably seen all this. How many of these strategies have y'all done, Michael? Do y'all reckon that you? Yeah, protected puts are pretty popular. They're just so expensive right now because the VIX is so high. And that's the other thing is, if you're buying an option, the VIX is elevated, you're paying a lot. It's very, very expensive. I think the VIX is still well above 25, isn't it? I haven't looked at it in a couple of days. wow, above 30. So 32. You know, if you look historically at this, what should the VIX be? So the VIX really is the standard deviation of the S&P 500. And you can go back and look at that number and see what it is. And its range depends on how far back you go. If you go back to the Great Depression, it gets up to 19. But if you leave out the Great Depression, it's more in the 15 to 17 range. And so I don't know where it went. It's still trying. So you can definitely see 2008. You can definitely see COVID. You see the Tokyo earthquake. I don't know what happened there. You definitely see the .com crash, although it looks a little early there. Maybe this is some Enron or something. But the median is 17, which is pretty close to what the S&P standard deviation is. The max is going to be probably 2008, although it looks like COVID beat it. We were pretty uncertain back in COVID. So 82.69. Yeah, that was March 16th, 2020. A day you'll be telling your grandkids about. Maybe, maybe not. It may not be that big of a deal because a million other things happened once China attacks Taiwan. So it has fallen below 10. When it falls below 10, I always go out and buy a bunch of options. I'm like, they're so cheap, they're on sale. It makes a big difference. There's a huge different option pricings between 30% and 9% volatility. They're really, really, really cheap. When I see a VIX below 10, it's as if I'm in California and there's a fire outside my house and I call my insurance company and say, can I buy homeowners insurance? And say, oh yeah, we got a deal right now. If your house burns down, we'll build 2 houses. It's like, okay, you realize I have a fire outside my house. Oh yeah, we're having a special today. You're like, that doesn't make any sense. So when the VIX to me is really low, that means no one's worried about risk. That's when I think something's about to blow up. No one's paying attention, they're complacent. So it's like being able to buy really, really cheap insurance when there's a fire outside your house. Yeah, I'm going to always go for that. It got pretty low. You can see there's times, and you notice here it really jumped up. Here it took it a while. It did jump there. But right before 2008, the VIX was down at that 10 level. So what do you do when the VIX is at 80? The VIX is at 80, you say, boy, I better buy some insurance. That's not going to work. The VIX is 80 is like your house is currently on fire. And you call State Farm and say, can I get some homeowners insurance? I remember I was helping this guy move when Medina Lake dam was going to burst. So he calls USAA and he asks if he can get flood insurance. And I heard him say, he goes, 30, what about 30 minutes? And what did USAA just tell him? Flood insurance has what? A 30-day wait period. He's like, 30 days, what about 30 minutes? But no, they weren't going to sell him because the flood was going to take his house out. So yeah, you just, it's too late. You're not going to buy insurance when the VIX is at 80. Now you might sell insurance at that point. If you had sold options right here, you would have made quite a bit of money. Would have done extremely well. This is when selling a straddle makes a lot of sense. If you have what? A lot of guts. How many people in March 16 are saying, I'm going to sell some straddles? March 16, we're saying, wow, this could get a lot worse. So you got to have a lot of guts to be able to do that. But if the VIX hits 80 and you got a lot of guts and you want to sell some straddles, and yeah, you go for it. How high can the VIX get? You would think it can never get above 100% because stocks can only lose 100%. But in the 1987, When we had the market crash, 23%, the VIX supposedly got above 100% at that point. I don't have that data anymore, but the lady who developed the VIX is a professor from Rice. She sent me all the data, and I should have taken it with me from UTSA, but I didn't. But she showed that the VIX actually went above. We don't really know what that means if the VIX goes above 100, because it doesn't really theoretically make sense. But we are at a pretty elevated place. So the 90th percentile is at 28. So we're above the 90th percentile right now. We're at 33 or whatever, 32. So we're at a pretty extreme. Okay, so this is not a time you want to be buying options. If you're worried about risk and you're buying options, you missed your boat. This is the time to sell options, maybe if if you're confident that no major issue is going to hit. We've already gotten the news of Russia and Ukraine. I doubt China's going to do anything, but they're eventually going to do something in Taiwan. I think that's going to be a world-shattering event when that happens. So could something come out of left field? That's why y'all see why when the VIX is at 9, I'm like, I'm just going to buy options because stuff comes out of left field without announcement, because that's what out of left field means. So there's always something that can hit us that we're not ready for. So, especially geopolitical events. It's unlikely economic type of things, and like suddenly economy's growing really well and suddenly going to recession without a COVID or bank crisis or something like that in the middle of it. So what you can do with this, which I find really, really interesting, is to actually get the S&P 500 and calculate its standard deviation and graph it against this, and you'd be amazed how close it tracks. So if you get the S&P, go back the last 90 days on the S&P, get its price change and get that standard deviation, you have to annualize it. But when you take the annualized 3-month standard deviation of the S&P 500, it very closely matches the VIX. Except at the extremes. At the extremes, it doesn't quite, but if I were to graph the two, I should have done that for you, but if I were to graph the two, you'd have a tough time seeing the two lines versus each other. So the VIX is heavily influenced by what the market's done the last 30 days. Very, very closely tied together. So, and you can kind of see that, right? The stock market got really volatile here. The VIX is a prospective number. The VIX tells you what the option market thinks volatility will be the next 3 months. But it's heavily influenced by what it's been the last 3 months. So if you're a reversion to the mean kind of person, then yeah, you can definitely take a bet on these transactions. Okay. So that's it for options. Any questions on options? Y'all need to be trading options in a paper portfolio just so you can say you have and try some strategies. You see the VIX at 80, then try shorting a straddle, and then if it's a paper portfolio, what do you care? See what happens. All right, one last thing I want to try, and we'll talk about the exam real quickly. So this has been a strange 2 semesters because students have never been this unengaged in my classes. I mean, the best students are very engaged, but the unengaged students, it's like they're not back yet. So I think the stress has just been too much. So it really bothers me. There's got to be some retention. So y'all are about to depress the life out of me, but let's see. Someone comes to you with $500,000. How do you address them? What's the first thing you do? What are you going to do? You're going to build them an investment portfolio. What's a portfolio? Don't look at your notes. It's a collection of assets for what? Some future purpose. What might you ask them? Why are you investing? What might they say on that one for most people? Retirement. All right, what's the second question? Well, what's the most important thing on the first question? Why? You want to know their what? Their time horizon. That's really, really important. You always start there. Are you investing for next week? Had a student just say, remember who? It might have been someone in this class. So, you know, I gotta make a payment in a few weeks. Should I put it in small cap value stocks? It's like a few weeks. Why don't you just go to Vegas? You know, it's like, if you need that money in a few weeks, you better just put it in a savings account. But if you need it in 30 years, then yeah, you can do other things. The second question is, why can you invest in, and what are you looking at there? Asset classes. What's your question on asset classes? Do you want to have 50 asset classes or 2? What might be a good answer? Yeah, 10 to 15 if you like William Sharp. Why? Because you want to be parsimonious. I saw that word in an Economist article just this week. Parsimonious. What did they say? Oh, they're talking about some people are more parsimonious than others, but I can't remember what they said. All right, so you want to be parsimonious. You want to have enough asset classes that you can explain a lot of risk, but you don't want extra ones because that's a ridiculous amount of extra work. You got to hire more managers, interview more managers. And then the last question, how are you going to do it? So there you're going to look at what? Hire someone to do it yourself. Are you going to be blank or blank? Passive or tactical? All right, so those 3 questions. What are the 4 major asset classes? Stocks, alternatives, bonds, cash. What's the difference between cash and bonds? That sounds like the same thing to me. You're loaning somebody money. Why don't we break those 2 out? What's the 2 risks that you distinguish there? Reinvestment risk and price risk, all right. Bonds, what are the sub-asset classes in the bonds? What's the acronym? DC cuts I, so duration, convexity, credit. The U, you remember that one? US versus non-US, usually goes into alternatives. The T, taxes, you got municipals, you got taxables. The S, structured, so you have these, you know, financial engineered, and then the last one, the I, inflation, you have tips versus taxable. On the stocks, you wrote about the expected return on stocks in paper 3. So what's acronym for stocks? Bucks. So B, beta. So what kind of stock do you have under beta? Cyclical and defensive. The U, US, non-US, which includes developed, emerging, frontier. The C, capitalization, you have small, mid, large, micro, penny stocks. And then the S, style, you have growth and value. What's growth doing this year? Selling off. What are interest rates doing this year? Rising. When the growth stocks do badly? Rising interest rates. And in alternatives, you have real assets and you have others. So real estate, timber, commodities. All right, so y'all haven't forgotten everything. That's pretty good. So try to remember this stuff. This is pretty critical stuff. All right, so what about exam 2? So exam 2, I gave you an exam guide, which is the exam. So this is the exam. There's no essay questions on this one. I used to have an essay question on this, but those essay questions are identical to what you did on papers 3 and 4. So I decided to just let you off the hook, with the one exception of the relative value thing. But got to do your returns. You got to give me a beta. So there's a little essay in there. Make sure you have these 4 sections. Price of corporate bond, you should have done that in 3013. Price of stock, should have done that in 3013. The relative value one, the one that students miss the most. It's the worst question on the exam. This class hopefully will fix that for me. And then what we just did, the gain and loss. This is my most commented YouTubes. The students and people from all the world are like, I'm so thankful you did this YouTube. I'm like, this is like a really simple problem. doing options. Options is another class. We're doing real simple intrinsic value. For some reason, there's some shortage of that type of analysis. The other thing I gave you was an actual practice exam. This is a previous semester's exam. So what I will do probably on Friday is I'll set up a Zoom and I'll work this on the Zoom. You don't have to be on the Zoom because I'll record it and put it out there, but I'll work it. What I recommend that you do is Wednesday and Thursday, you work this, study for it first, then work the exam, and then come to the Zoom if you can and ask questions. Make sure you're comfortable with it on there. All right. So pretty straightforward. Again, this is the most missed question on the exam. On this one, most students get 100% on 1 and 2. You don't know what this third question is going to be, but it could be a covered call, could be a collar, could be a protected hood, could be a straddle. It's only going to be one of those 4. All right, I've only given you 4, so we're not going to do spreads or any of those kind of things. Mainly because I really can't do spreads in the way this is set up. I don't give you enough information to do it. So it's going to be one of those 4, but if you have everything we just did, if you have this and you know the intrinsic value formula, it should be pretty straightforward. You're just plugging numbers into really simple formulas, so it shouldn't be that difficult a question. But most students do get the first 2, because again, you just plug it into that formula, S minus X comma 0 minus option premium. Very, very straightforward, very easy. I will pick a company. It won't be BBY, but I will pick a company that goes throughout the entire exam. All right, so that's going to be on Monday at 3 o'clock in here, in person. There are no Zoom. Some students I'll meet for the first time, maybe. It's just strange to me. The attendance is required, and for some students I haven't seen in months. All right, so I want you to remember this. You may never take my class again, which is fine. Some students hate my style. I really want students to actually learn this stuff. Some students like, I want to graduate knowing as little as possible. I don't like your style. Give me a bunch of multiple choice exams, or I forget everything 2 minutes after exam. But even if you didn't like the class, don't like me, I'm still your professor for life. So you can always still call me. You don't have to tell me you didn't like my class when you call me. You can just pretend like you liked it. I do want y'all to succeed. Success in finance is 2 things more than anything else. It's curiosity. You got to like this stuff. If you're bored in this class, then investments is not going to be the thing to do, because this is what we do. The reason I love teaching classes like this and talking about stuff I really find fascinating. And the second thing, you've got to know stuff other people don't know. Finance, I love finance because it pays you for what you know. Hopefully that's true of every career. But finance pays you more money, and it pays you for complexity. The more complex stuff that you know, that's why you got to just know this stuff. Everything we covered in this class is pretty basic. You just got to know it. It's what every finance major knows. And you got to know it 5 years from now, not just 5 minutes from now, not just 5 minutes after the exam. You have to know it forever the rest of your life, because you're a finance person. So there's just certain things you just have to know. So there's nothing on this exam that you should memorize. Everything on this exam, you should just know off the top of your head from now on for the rest of your life. All right. It's that critically important. If you want to be successful, if you want to be a failure, then yeah, forget it all. It's real easy to be a failure. I was watching a video of this judge. Boy, she was good. It says, don't be a failure. Anybody be a failure. That's easy. She was talking to these at-risk kids. She said, be somebody, do something. So how do you be something in finance? You know stuff that's complicated, it's hard, it's difficult, and you know it better than anybody else, and they will pay you a fortune for that. And hopefully you enjoy it. So that's the key. It's not that difficult, is it? You just learn stuff. You come to class, you debate, you read, you Google search, you get into it. Some of you are really got into papers 3 and 4, which I love, and really just kind of delve into it. That's what you got to do. All right, that's it. If you need your paper 3 and 4 information, let me know. That's it for me.